Good morning, everybody, and welcome to MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Here to check out everything that is hot on the U.S. Open. Taking a look at the markets right now, you have bonds up, both the 10-year and the 30-year, but you do have the short end of the curve a little bit mixed. But again, we have bonds up. We have the Dow Jones up 86 points at 19,907 on the futures. The Russell 2000 is up 1080 at 1365.10. You have the NASDAQ up 1550 at 5146, and the S&P 500 is up 8 points at 2383.50 on the futures. Crude is up by a penny at $53.54, and the U.S. dollar is ticking in the red, becoming weak, down at 99.78, almost 99.79. And this is probably not the response that most people would expect, especially after we saw large cap tech name Amazon have a 4% decline after reporting basically really poor earnings and first quarter guidance. Now, I guess the market's just shrugging this off as a secondary consideration because really, after looking at what Apple did, Facebook, FOMC meeting, stronger than expected economic data in the form of January ADP employment change, manufacturing ISM, index reports, all really positive. Bottom line is that we're keeping an eye on the macro considerations as far as the markets are concerned and as it relates to employment and regulations. Speaking of regulations, take a look at the financial shares. They're exhibiting some pretty significant strength. JP Morgan Chase, Citibank, Bank of America. You're also seeing some of the brokers on the move. Charles Schwab, E-Trade, Fidelity, Fidelity's private, Interactive Brokerage, all moving to the upside. That's basically because there have been some headlines out that there's going to be some impending Dodd-Frank announcement, as well as the Department of Labor fiduciary rule developments that are going to be rolling out as far as whether or not they're going to repeal components of these current rules and pending rules that are going to be rolling out in April as far as the DOL. That could really move the financials pretty significantly, and we're seeing that move, and it's been propping up futures as well. The other thing is that when you look at the January employment situation report, it reported a couple things. One was that there was a slowdown for activity in China, especially for their smaller manufacturing companies. That probably explained why you saw a little bit of a pop in short-term interest rates. The People's Bank of China actually raised rates overnight. They're trying to basically keep currency and their reserves up and try to cool down that red-hot real estate market. The other thing, too, is that when you put in the stripping back or pulling off some of the Dodd-Frank rules, as well as maybe completely repealing or not even rolling out the DOL rule, it's almost like you're putting an HGH mix, that little steroidal type of push to pump things up from a trading standpoint. But we haven't seen the muscles flex in the markets yet. And I say that only because as these headlines have been coming out, and basically from earnings and the economics reports, and now the movement into changing financial regulations, the S&P 500 at this point is basically only up about 0.1% since Monday. And while it's been pretty favorable with the fact that the markets have been able to hold up in the face of all of this mixed type of action that's been going on in reaction, I have to say there's a little bit of a tempered look that you might have to take, especially with the fact that when you look at, like, for example, the non-farm payrolls that came in not too hot but not too cold, but you had then lower average hourly earnings. To me, when you see that average hourly earnings were expected to come in right around where they were at December at 2.8%, and they come in at 2.5%. While you might want to call this a Goldilocks, that's what I'm hearing from pundits out there, a Goldilocks set of reports, I look at this is saying this is a wait and see. We're going to have to wait and see what the results of these pending deregulations, these pending fiscal stimulus plans. And at this point, that means that I'm keeping powder dry. The other thing that I saw after the announcement was the U.S. dollar continues to peel off. Now, President Trump did indicate very early, a couple weeks ago, that he wanted to see the dollar not as strong as it's been. And it trailed off pretty considerably, and you're seeing global currencies moving to the upside on that downtick. You're also seeing short-term interest rates moving. Basically saw the yields in the 2-year go from 1.22% after the employment report. It went to 1.20%, which is basically telling us that the Fed may not be moving as quickly as we thought they would, thinking that everything was red hot, especially again as we aren't seeing those hourly earnings and that wage inflation continue to increase and stay stable to the upside. You don't see that, folks. I don't see how this is going to continue to move to the upside at the velocity that we've seen over the last couple months. That means you keep your powder dry. Okay, folks. This is it for What's Hot on the Open. Join me at 1:30 Eastern Time here at MarketStream.live, where I'll be covering all the midday action and strategy now. See you then.